Fee as well.
All right, thank you very much. So, part A of the question is saying, explain the concept of efficient capital markets. And in here, you have to take into account the assumptions and how, it relates to the random walk hypothesis. So you need to explain the concept of efficient capital markets. Efficient capital markets, you should also please take care of the assumptions of the efficient capital market and at the same time show how it does relate to the random walk hypothesis or random walk theory. That's part A of the question. 10 marks. This is a lot of work. You can manage to do this. So now, the concept of efficient capital markets. To start with, what do we understand by capital markets? First of all, what's your understanding of capital markets? What is capital market? Okay. All right. So the capital market is part of the financial markets. All right. The capital market is basically part of the financial markets. Capital market itself is a market where, the securities, right? The securities, those are long-term debt and equity instruments are actually traded, all right? The market where the long-term capital and the equity and the debt instruments are traded is what you call the capital market. It is called the capital market. So this is a market where the people who have insufficient funds want to come and raise funds from, right? When they want to raise some money, the company needs money, they will just come to the capital market and raise funds. And when you come to the capital market will bring together the people who have surplus funds. Those are investors, usually call them the investors, and also the people who have a deficit, the borrowers, right? Those who have a deficit, the borrowers, they will meet at this particular market. The borrowers, these could be the firms that need funds to invest in their capital structure. So this kind of a market that tries to bring these guys together for transactions, it is called the capital markets. And we are specifying that they come together to trade in long-term debt and equity instruments. Is that clear? All right, we hope that is clear. I've just said what capital market is. I have not yet commented on efficient capital market. Now, when we talk about efficient capital market, now we add another word. It's no longer just a capital market, but this one now is efficient. So when you say efficient capital market, this one is a financial market where the prices of these securities, a market where the prices of these securities fully reflect, all available information at any given time. I repeat, there is that financial market, right? Or that capital market where the prices of the securities, and by securities, we mean both the equity and the debt securities, fully, actually, and instantly, because usually if it's efficient, it should be instantly, fully and instantly reflect all available information at any given time, usually. So the prices of securities have a lot to say. Usually in the prices, like the value of, for example, shares, in the value of a share, like the price of a share, we have a lot of information embedded in that price. You know, usually that captures the information that is available. Now, depending on how efficient the market is or how inefficient it is, if the market is extremely efficient, like this, very efficient, then you find that the share prices, for example, let me just, for simplicity of the conversation, let me just talk about share prices. The share prices or the prices of these securities will quickly capture all the changes that happen or all the information that does get to be availed or that becomes available in the market is quickly captured instantly. And then you will see if there is some information that affects the share prices negatively, you will see the share prices falling there and then. If there is an information that is that would make the share prices of that particular stock increase, then you will see the price increasing there and then. Okay. Now, that is what efficient capital market is. Now, when you look at this concept, it is actually grounded in the belief that it is very impossible to consistently achieve returns that which word should we put, that outperform the overall market performance. You know, it's not really possible. You can't really gamble. You can't consistently predict the movement of the share prices. Let's say, okay, now tomorrow they will be increasing, that other day they would be increasing. Sometimes you may say the prices of these securities are increasing, but you are shocked very soon they start falling again. So there are all those things that happen. There are those changes. And usually those changes, they caused or fueled by some changes or some information that happens in the particular market. Those activities happening in the market, information is flowing, it has to be captured in the share prices or in the prices of the securities. So this is what really does happen. Now, we have some assumptions that have to hold for this. We have some assumptions that we are making for this efficient capital market to be there. One, we assume that information is free. It is free. We have free information. Information is free, meaning there is no cost for information, and it is widely available. This is the assumption that we make. You and I know in reality that the quality of the information that you will have is heavily dependent on the costs you pay. There is always cost for information, right? You pay for good quality information is never free. Good quality information. If you need the high quality information, usually you need to pay for that. There is a cost attached to that. But in here, we assume that the information is free and it is widely available. The second assumption that we have is we assume that the investors that we have are rational. Yeah, these are assumptions. These are Modiglian, the Modiglian and Miller, assumptions. The MM assumptions. Sometimes the question would be asked of the Modiglian assumptions. These are the Modiglian and Miller. Modiglian and Miller assumptions. These are the information costless, no costs, free information, widely available. One assumption. The second one, he assumed that investors are rational, right? This guy is the one, Modiglian and Miller. These are the two guys that that expounded this model we are talking about, the efficient market hypothesis. They're the ones that really, expounded this one. And so they, for their model or their theory to hold, they made some assumptions, and these are the assumptions that we are trying to go through. Okay? They assumed that the investors have to be rational for this theory to hold. And what do we mean by rationality of investors? Investors, they should process information rationally, and they have to update their expectations accordingly. That is if they are rational, right? They should work based on the information that they have been provided. In terms of making decisions of what assets to invest in or what options to invest in, yeah, or or what source, really, what form of capital, what instruments they have to get, yeah, or what securities they have to buy, it should be dependent on the information available. It's an assumption made. Because even if information is available, high quality information, if the people are irrational, the investors are irrational, then they will not ride on the information they have. So we assume that they are to be rational for the theory to hold. Are we still connected? Hello? Can you still hear me? Or maybe I'm not clear anymore.
We can hear you.
Thank you very much for the confirmation. You also assumed that for this theory to hold, there is no transaction costs. No transaction costs. Now, listen carefully. Listen. A model is one way of organizing thoughts around theory. It is a compact way. And so modeling is very, very crucial, in the field of finance and economics. We usually simplify the complex world by using the models. And these models, they are highly utilized. Now, usually when you design a model or you come up with a theory, a proposition, you'll have to come up with some assumption, because remember, it's one way of simplifying the complex world around us. Models are supposed to be simple. And remember, the world is complex, right? Very complex. You can't simplify the world. So when we are modeling, we are just trying to simplify the complex world. Since it is not really a proper representation of the reality, there should be weaknesses that should be there in the models. We have to put some assumptions. Some assumptions have to hold for that model to work, or for that simplification to stand. So the simplification of reality, a model, we shall have these assumptions hold. And in case of the model that we are looking at, well, this theory that we have now, the random walk one, there are these assumptions that have to hold. No transaction costs. So that is to say, people are not, they shouldn't be paying anything when conducting these transactions. Say you have these transactions happening, like you are buying, let's say you buy securities, there are no costs that you have to pay. That is if the market is very efficient, the efficient capital market hypothesis. It's an assumption that we make. But we do know, we are not saying it's just an assumption that we make. In the real world, practically what happens is that there is a cost. There are transaction costs. For example, if you are buying today some shares, some stock of a certain company, there are costs that you pay. You pay to your, there's some costs paid to the broker, some costs paid to Luce, some costs that go, Luce, by the way, is Lusaka Securities Exchange in our case, or the Securities Exchange. If you want to participate in the London Stock Exchange or London Securities Exchange as well, there's some costs that you really pay to the stock exchange. And also you pay to the Securities Exchange Commission. In our case, we have Securities Exchange Commission of Zambia, SEC. right? There's also some amount that you pay in that transaction as well. So there are these costs really. But in this model, as we are trying to simplify it, we say there are no transaction costs. It's an assumption. It's not really the reality. The other assumption, that we have is we assume that there are large number of participants. We have really a large number of participants. Large number of participants, meaning there are many rational profit maximizing investors that act independently in the market, right? We have a large number of these participants, working in this particular market. It's one of the assumption that we actually do make, because if we have a large number of participants, and actually even in reality we have these large numbers, because you see, when you come practically on the capital markets, even on, for example, the Zambian capital market, right? If you check in our capital market master plan of 2031, right? It's 2031 or 2032, 2031, somewhere there. It shows, you will actually see a large number of people that participate in this, right? And mainly, the giant participants are institutional investors. When you talk about, for example, a conversation of stocks, right? Buying shares in companies, usually it's not just limited to individuals like me and you to buy shares in companies. Usually companies buy more shares. They buy shares in thousands, in millions, in fellow companies. That happens, okay? The institutional investors. I try to say a lot of things on each point just to take an advantage and teach some things. You see, for example, the pensions, the insurance companies, for example, the insurance companies, the pension schemes like NAPSA, the banks, right? Those are the guys that participate a lot on the capital market. They buy usually these securities in large quantities. All right? Because when you pay money, for example, to an insurance company, listen, when you submit your premium, you know that the insurance company doesn't just keep that money to just stay there doing nothing, because very soon you may go there back to claim. So usually the insurance companies, they invest that money, make more money from that, so that when people go to claim, they should have found that the company have made more money. So they invest that money. Sometimes they invest in stocks, they invest in bonds, they invest in treasury bills based on their goals. Yeah, they also invest in funds, some specific funds. The trust funds, you've heard of trust funds, isn't it? You know the CISs. Anyone who has a clue on the CISs? You know the CISs? You know the CISs, eh? We have never heard of the CISs. Or someone knows about the CISs.
No, no, sir.
Okay. A CISs is basically a collective investment scheme, this one. You know SEC, but SEC, SEC always has a conversation every month, the last Thursday of the month. They usually have a conversation. Even today they had one. because it's the last Thursday of the month. They had a conversation today. They actually, in today's conversation, I was invited in that class. I was there. It was today in the afternoons. We're discussing the CSIS, Securities Exchange Commission. That's the SEC I'm talking about. We were discussing what's this, the collective investment schemes. The way how they do work as well. You have the fund managers. I don't want to get really in details so that you are not lost. You have the people who are called the fund managers that manage your investments. So you are just putting money there. You pull money. Different people putting their money together, like the way how you do Chilimba. You know Chilimba, obviously. You know Chilimba. Chilimba is a local stuff. Chilimba. None of us understand. Like there are some people that don't know what Chilimba is in here. Chilimba is really a local name. What is the English name for Chilimba really? I saw Chilimba also in the Finiscope National Survey. It is labeled as Chilimba. What's the English name for Chilimba really? What's the English one? Most of the papers that I've read. Yes. Sorry?
Others call it village banking. Others, there's also something called silk, but they do the same things. I'm not too sure if it's the same thing, but it's village banking or.
Okay, village banking is Chilimba. Wow, interesting. Because what is confusing is that when you read the national survey, the Finscope one, especially the recent one, they had this presentation. They had Chilimba, village banking, and they were all separate. There is also SACCOs, all those stuffs. I don't know how different they are, but we just grouped them as the informal financial, really, informal financial services. Okay, but let's not really lose focus. Yeah, there is something like that called the collective investment schemes, where you put money together instead of the way how you just rotate money like in that Chilimba stuff, where this one is the one giving to this one is the one giving to this. You put the money together, then you invest that money. Like there is a fund manager who invests on your behalf, a specialist actually, well-trained with proper experience in investment. You get that money, you put together, you invest maybe in bonds, you buy a bond, a collective one, as together now. One bond together or bonds together, you buy shares together, you divide your money like that. Some of your money, if it's much enough, you may even invest in real estates. Real estate, you buy land or you buy buildings, right? You buy infrastructure, buildings, then people will be paying rentals. There's such kind of, arrangements, right? We should start thinking in those lines. I'm campaigning now also on behalf of the CIs guys. We can start thinking of such things, even as individuals. We can do those when we come together, instead of just saying, today you are, every day you should put 200, 200, but that 200 is not increasing again. Tomorrow 200 is just going circles. We could devise a way of multiplying that money and make those investments, right? It's a good stuff. Wow, we are getting lost. Are we digressing? No. The message we were sending is that there is a large number of participants. It's an assumption, and this is also true. Is really happening at the moment. Any questions, comments, concerns? Don't worry, this is just general finance. You can even pass other comments. You already know these stuffs. Do you have any question, any comment, any concern?
Have we related it to the random value theory?
We haven't yet related it. We were just talking about assumptions yet.
Okay.
Yeah, if you check the way how we are moving, we have defined what the capital, we have explained the concept, we have talked about the assumptions. Now, what is the relationship of the same to the random walk theory? That's a question. What does the random walk theory really posits? What does the random walk theory posits? Now, the random walk hypothesis or theory posits that stock prices, they move randomly and usually unpredictably, right? The random walk theory has it that the stock prices move randomly. We are first defining what random walk means. They move randomly. All right? Randomly and unpredict what? Predictably. Unpredictably. You can't predict. Meaning that the past price movements or trends cannot be used to predict the future price directions. Okay? The past price movements cannot really be used to predict future price directions, like effectively. Now, when you check the theory supports the efficient market hypothesis. The efficient market hypothesis. How? Because if markets are efficient, listen, if the markets are efficient, then any new information is already reflected in the what? In the prices. You get that, right? The new information will be reflected in the prices of the stocks, and the changes in these prices, they occur only if there is a new information that comes. We know that the changes in these prices, right? They occur if there is a new information or an unpredictable information comes, then you see the spark, the price change, the prices will change, right? So the relationship is that this theory, the random walk hypothesis, it supports the efficient market because the markets, when the markets are efficient, any new information is reflected in the price movements. And with that, then you can actually see that there can not be these deviations, right? But we do know that since these prices, right, the price changes, they occur due to new and unpredictable information that comes. You see that the share prices will follow the random walk. All right? The share prices will follow a random walk because of the new information that comes and that affects the share prices. Did you pick it? No, you didn't. Let me say it in this way and summarize it. The relationship is like this, colleagues. Random walk hypothesis posits that the price of shares changes, right? So now, when you talk about the efficient market hypothesis, if the market is efficient, what happens is that every new change that will happen in the market, it will be captured by the share prices, and you see the share prices will change. So you know what? When the market is efficient, any simple change that happens in the market, the share prices are going to respond. You understand, eh? It is different from the market which is not efficient. If the market is not efficient, even if something changes, even if there is a change in the information, like there's a new information, nothing will happen. You find that the share prices will still be the same. Especially when some markets are not really strong, like some markets. I don't want to mention the names of the markets really for security purposes. So yeah. You find that there was this Ukrainian war, right? You found that it took a lot of time for the share prices of companies to start really responding. A long time, like months, more than 6 months or more than 3 months. You know, the share prices are still intact, but there is a change that has happened in the economic condition and the environment. Why? Because the markets are not what? Efficient. You're following, eh? So if the market is efficient, you see that the information will be coming at different times and it will be coming randomly because it's unpredictable. New things can just happen. And then you find that also the share prices will be changing based on the new information that has happened in the efficient market. So that's why the share prices will end up following what? The random walk. Is that clear? I have said that the efficient capital markets will allow information to be coming every single time there is a new thing that has happened, new information, that will be captured in the share prices. And you see the share prices swinging according to the new information coming, following the random walk. Have you heard the relationship now? I've even summarized it. Any question? Do we have any question? Comment, concern?
Maybe a question for me. I don't know how I'm going to put this question. Maybe in relation to what Mr. Shakafusa posted yesterday about CEC and the 1 billion something on the is it Luce or something, and how I would like to ask from the relationship with that announcement and the share price. How would you explain that?
Oh, wow. What a good question. Good relationship. You see, Mr. Shakasungu is a very good advocate of CEC. It's just like me. I also stand a bit biased, support CEC, right? Now, when you have new information like that, for example, for CEC, and people see it on the media, do you know what is going to happen? What is going to happen is that many people are going to be wired psychologically to believe that CEC is a powerful company. You hear the message that is being sent there. This is a powerful company. Putting CEC on spotlight. You get it, right? So many other investors, both institutional investors and individual investors like us, who don't yet have, who might not have shares in CEC, many people would want now to join us and be part of the shareholders of CEC. You get the point, eh? Why? They will now demand they will demand to be part of the shareholders of the stock for CEC. They will demand the stock. Because of the increase in the demand of the stock, like many people buying, then the share price is projected to start what? Increasing, because what increases the share price is the demand as well. How much demand is there? What is demand? Like the more people are buying that stock, like many people want to become part of that company, then the share price will start going up. On the other hand, if there is bad news that comes with the company, then you see many people being sad, and others will start selling shares of that company. They are no longer interested in holding shares of that company. If you have more sales than the buying, more people selling the shares of a company than those buying the shares of that company, then it means that the company is no longer on super demand. You understand, right? So you see that the share price of that company will start going down because people are not even buying the share price of that company. The shares of that company, they are actually losing the shares that busy selling. They no longer want to become part of shareholders. Something like that. You're good? Let's see what really happens, but you would speculate in those directions. Are we connected? Are you okay now? Do you have any more questions? Is there any question? Oh, you are okay. The person who was asking is fine, right? Are you okay?
I'm good, thank you.
Oh, you're welcome. So now, you see, most of the that I'm on B now, I've gone to B. Most of the early work related to the efficient capital market was based on the random walk hypothesis, actually. However, much of this academic work contained some extensive empirical analysis without much theory behind it. So it is for this reason that this guy, Farmer, divided the overall efficient market hypothesis. He did a very good paper. You should follow it. It's there online. Farmer did this study, yeah, a very good paper. Yeah, he did a very good paper on this one. He did justice. He did a paper and he divided the overall efficiency market hypothesis and the empirical test of the hypothesis into three. This is the one who did these divisions. And he said, number one, there is a weak form of efficient market hypothesis. There is a semi-strong form of EMH, efficient market hypothesis, and there is a strong form of efficient market hypothesis. That's what he said. He said we can't just say there is efficient market hypothesis because really it was just combined together previously. But with the work of the guy, he had to divide this theory of market, efficient market hypothesis, the hypothesis into three. And these three ones, we do really have them. Okay? He said that we have weak, semi-strong, and strong form. Let's start and let's go over these. One, we are starting with the weak one. I'll just pass comments quickly on what he said about the weak one. You know what he said about the weak one? By the way, he did his studies in the 1970s. He said that here, the stock prices reflect all historical market data. All historical market data, like the stock prices. They reflect, what do they reflect? Oh, historical market data. They reflect all historical market data, such as what? The past prices, the trade volumes. Those you can even find them on Lucy website for each company, and the returns. These are usually there, reflected in the share prices. That's what he said. Okay? So the share prices only reflect the historical information. That's a key word to take home here as I summarize this. But in the semi-strong, you can even read his original paper, by the way. It's there online. In the semi-strong, he said now, the share prices, they reflect the information that is historical plus the information that is available to the public, that is publicly available, all right? So you combine historical information and the current information available to everyone in the public. That is published, right? Available to the public. And this would include things like, for example, financial statements. Financial statements you saw when you are doing your analysis, your assignment 2, is it assignment 2 or 1? That one where you're going to the website and pick financial statements. You saw that information is made available to the public, the news, the macroeconomic data, right, such as inflation rates and all those are captured in the share prices. They capture the information that is available to the public and that one which is historical. That is if the market the capital market is what? Is semi-strong. What about if it is strong? As we conclude, 3, strong. If it is strong, the information will have both historical data plus public plus private, the inside information. When you have a very strong market, capital market, the share prices will capture all the information, any manner of the information, be it public, be it historical, or be it private. That's the key thing. They even capture the insider information. Like what we mean by private information, we mean that information which is not put publicly. It's not there online. It's not there like or for public consumption. All right. The share prices are able even to capture all the information, including what is not yet made public. That is if the market hypothesis is very strong. You have a strong form of efficient market hypothesis. Very strong form. So basically, these are the 3 alternatives. And as I conclude, I should. Number 1, weak form, just the share prices capture historical data. 2, semi-strong form, it captures both historical data plus publicly available information. 3, strong form captures historical, public, and it goes further to capture privately available information.